And this is the 2007 moment for the US. And what I mean by that is in 2007, the Bank of Japan said, no more QE. We're going to stop QQE. And here we are 16 years later, and they have, or 17 years later, and they have, almost twice the amount of bonds on their balance sheet. It's the boiling frog problem, right? You just keep thinking it's all going to work out. And then you realize, wait a minute, why am I paying, $18 for a hamburger? And why is gasoline costing $4 a gallon? That's because your money isn't as good as it used to be because they had to print more of it to fund these deficits.
Last Wednesday, the U.S. Federal Reserve announced that the Bank Term Funding Program, BTFP, a funding lifeline created during the regional banking collapse last year, will end as scheduled in March. The announcement put an end to speculations about whether the Fed will extend the program, especially as the conditions that caused the first phase of the crisis remain unresolved. However, the Fed said it's following the original schedule. It also raised the interest rate on new loans from the BTFP until the program ends in March. According to an announcement from the central bank, the interest rate on new loans would be no lower than the interest rate on reserve balances on the day of the loan. This would mean a nearly 50 basis point jump in new borrowing costs, with the BTFP going from a loan rate of 4.93% before the announcement to match the present IORB rate of 5.40%. According to analysts, the increased rates should discourage fresh borrowing, as it effectively ends what had become a popular and profitable arbitrage opportunity for lenders. Earlier this month, Fed Vice Chair for Supervision, Michael Barr, noted that there was no need to prolong the BTFP because it was designed for an emergency to ensure that banks have the liquidity they need. With the emergency now out of the way, Barr believes it's only right to end the program. However, Mark Yusko, a renowned investor and hedge fund manager, has warned that the Fed cannot afford to stop coming to the rescue now. In fact, Yusko believes the United States reached the point of no return last year, the same point Japan first reached in March 2006 when it vowed to end quantitative easing. But it has been a very long goodbye, especially to QE-like programs with similar purposes but a different name, just like the BTFP. According to Yusko, the Federal Reserve is about to get very creative with these programs, as the economy can no longer function independently without money printing and Fed interference. We will now bring you clips from Mark Yusko's latest interview with Blockworks Macro. Please watch, like, and share this video. Subscribe to the channel, and turn on post notifications for more videos like this. Thanks, and enjoy the video.
I thought this temporary program would have to be permanent. Look, we are going to re-enter QE. That's coming. QT is over. They're going to go. This was a stealth way of doing QE. Well, this is not QE. We're just lending these banks some money temporarily while their assets accrete back to par, because these are money good, right? The government's not going to default because the government can just go print more money. It's like the old Doritos commercial, crunch all you want, we'll make more. And I think the problem that I see here is 30% of bank equity. And we had, was it Jim Bianco? Somebody we had on the show last year who had the great chart of bank balance sheets. And it had the green as the assets and the red as the liabilities, and the gold was the equity. And, assets equals liabilities plus owner's equity. That's how accounting works. Well, the problem is if you bought these assets and they became impaired because you bought them at low interest rates and interest rates rose and now there's an impairment, the way the accounting works is those unrealized losses are part of equity. Well, but if they're losses, then shouldn't they detract from the equity value? But the thought is, well, but they're not real losses. They're just unrealized because they're going to be money good. And that's somewhat compelling as long as there's not a bank run, right? Because the challenge for all of banking, fractional reserve banking, and Caitlin and others rail against this all the time, is functionally bankrupt. It's a bankrupt business model, right? If everybody showed up to the bank and said, I want my money, you couldn't satisfy the demand and the bank would be out of business. And so time is your ally. It's like the opposite of the Maverick scene, right? Time is your greatest enemy. Time is your ally. Because if you can be given time to not have to pay out the depositors, or that's why you shut your doors, or to do a bank holiday. But I so long-winded way of saying I didn't expect them to stop this. But what we did see is the bank balance sheet, the Fed balance sheet ticked back up. So they were actually reducing the balance sheet like he said he was going to a year ago, and that's over. There was a tweet going around yesterday on Twitter about Ray Dalio talking about this, that functionally what happens when a currency starts to devalue is government essentially has to go print a bunch of money in the central banking facility and buy up all of the excess bonds. And you've been talking about this for a while with this wild deficit spending. Everybody was celebrating yesterday, the great GDP number in Q4. Like, sure, give me $500 billion. I'll show you a good time too. $500 billion spent in Q4 that we didn't have. Yeah, you can make GDP look really nice. So fiscal illusion is similar to monetary illusion. And it's the boiling frog problem, right? You just keep thinking it's all going to work out. And then you realize, wait a minute, why am I paying, $18 for a hamburger? And why is gasoline costing $4 a gallon? And why is that plane ticket costing $700 instead of $300? That's because your money isn't as good as it used to be because they had to print more of it to fund these deficits.
The BTFP was introduced during a regional banking crisis that caused the second, third, and fourth largest bank failures in U.S. history. Experts like Yusko believe the funding program only provided a temporary solution to the problem, ignoring the many underlying factors that caused the problem in the first place. When the program ends in March, Yusko and others have warned that the regional banking sector may be plunged into another crisis, and this time, the crisis will quickly spread to other sectors. This is why the Morgan Creek Capital founder and CIO is certain that there will be further money printing in the future. Let's get back to the interview.
And Andy talked about this, I think he even tweeted it, that there was an auction that was bad. It wasn't failed. It wasn't a tail because those primary dealers have to buy no matter what. But if you ranked it between, 4 and 9, it was a 4. I mean, it was ugly. And so does that mean the end of the world? No. Does it mean that we're reaching a point that is, again, unsustainable? Yeah. And everyone's seen the chart, and I wish someone would fix the chart crime. You can't show a 40, 50, 60-year chart in linear scale. You just can't do it. It's so egregious. And what it shows is, here's the interest on debt, and then the expectations in the next 3 years, it goes totally vertical. No, because the difference from going from 0 to $1 trillion is very different than going from 1 trillion to 2 trillion. It just is. And yes, that next trillion is a lot, but the percentage growth is not the same. And so they just need to fix those charts. But things that can't happen won't happen, right? So if we're at the point now where the interest expense as a percent of the budget is reaching the upper bound that it's never reached, that 21% level. So you say, well, why won't it go to 30 or 40 or 50%? If rates are higher today and we got to refinance all this debt that was, has 0 rates or 1% rates, and now it's going to refinance at 4 or 5, then the interest rate is going to go beyond that. Nope. I mean, they'll either, right, buy the bonds and retire them, right? Do some sort of debt jubilee. They will lower interest rates, despite the fact that we don't need lower interest rates unless there's an emergency, but there is an emergency. So it's just a different kind of emergency. And in the death throes of empires, this is what happens. And we've been talking about this a lot. And it doesn't happen over a month or a year. It happens over a reasonable period of time. Now, looking back in history, it seems like it was, instantaneous. but it's not instantaneous. But I said, I've been doing a little reading about Weimar. There's some scary similarities, very scary similarities to Weimar. And I'm not saying we're all going to have wheelbarrows of cash. I'm not there yet, but there are some scary similarities. There are.
On September 18th, the U.S. national debt hit $33 trillion for the first time in history. Today, the national debt stands at $34.145 trillion. That's over $1.1 trillion added in only about 4 months. As Yusko would say when describing the magnitude of a trillion seconds is equal to 31,710 years. To spend $1 trillion in that time frame, one would have to spend $1 every second for the whole 31,710 years. It's a whole lot of money. If this continues, the US will soon be adding trillions to the national debt in a matter of days. Please share your thoughts on Mark Yusko's interview in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.